we've got a lot to talk about. And during today's session, I'm going to be pulling up some different charts. We're going to take a look at some different stocks. Now, anything that Kevin and I discussed today, it's being provided for informational purposes only. It's not intended to portray any type of recommendation to buy or sell any particular security or to put on any strategy. It's just so that you get more familiar with some of the news that's moving the markets. And also we can answer some questions that you might have about some different trading tools and features that are available. We'll be focusing more on Street Smart Edge, but we'll also take a look at Schwab.com today because we're going to share with you the economic calendar. And then we're going to talk about, we'll talk a little bit about earnings. There are a couple stocks coming out with earnings this week, but really the earnings season kicks off next week. And we'll talk about that. And we'll just talk about some options concepts revolved around what happens to options prices as you head into earnings. And we'll do that more at the end of today's program. Now, I do want to stress that options carry a high level of risk and they're not suitable for all investors. Before you open an options account, please carefully review the options disclosure document. A link to that very important document is available on the bottom of this web page. All right, Kevin, let's go live. Now, I was out of the office a few days last week. So you're going to have to fill me in a little bit on, what's been going on in the market. But I took a look at the major indices, and I also took a look at some of the things that were moving the markets last week. So I also thought we could take a look at the calendar, what's on the economic docket this particular week. And maybe if you're looking out for anything, or maybe, maybe this week is not, maybe you're looking forward more towards next week. So I thought that's what we could start with. All right, so here we go. We have a chart of the S&P 500. Each candle that we have represents a day. And then I have different simple moving averages. The orange line is the 10-day. The red line is actually the 21-day. I was trying to replicate Recognia. Recognia likes to use not the 20-day, they like to use the 21-day because they feel it better represents a month. And we can change it, of course. I'll show you how easy it is to apply different studies. Then there is a 50-day simple moving average. That's the blue line. The aqua line is the 200-day. Now, if you want, let me just flip it back. Let me click on View All Studies. I opened up the toolbox. And if you want to edit a study that you already have, just click on it. And then we'll change the period. That way we've got a 20-day. There we go. So Kevin, last week, the S&P 500 was actually up 4%. And that was the biggest gain that the S&P had for a week since early June, since June 5th. And some of the news that came out was Thursday. The strong jobs report that we had, that was rather surprising. I saw the report, and the unemployment rate, it fell to 11.1% from 13.3% in May. So the numbers are still really high. They're extraordinarily high. However, it looks better than before because we did create, it says that the US economy created 4.8 million jobs. Now, the market reacted to this on Thursday, initially positively, and then we fell back a bit. There was some selling, I think, at the end of the day. So what's your take on the jobs report? What are you thinking?
I mean, it was a very interesting report. We also, it looks like we did actually have a revision too for the prior month, the upside, but it did not seem like the market really was really concerned regarding the revision. They were really looking at the current unemployment rate and the initial claims that came out. If we can continue to see a little bit of a downtrend or even just a stabilization of new claims that are coming out in the jobs market, you could potentially see the market continuing to go higher. But overall, we've seen since the lows of the market a month and a half to 2 months ago, we've seen these job numbers that have come out, and it seems almost every time the market's actually been really favorable for them. So overall, to me, the data, like you said, it's still very high. There's still some real world implications. There's people that are struggling, and obviously we're going to try to get the economy going again and make sure that we can pull people up. But if you're looking at an overall macro view and what the equity market's looking at, it looks like it's very encouraged by the numbers that we're seeing come out. And as these states really open up, obviously we should probably see the unemployment rate continuing to go down, and then initial claims and continuing claims to go down. Now, Nita, the biggest issue that I would see that would be a big blockade for these job numbers are these states reopening successfully and not pulling back. And the really big states that we need to be concerned about is going to be California, Texas, and New York. Those are really the three states that obviously employ a lot of people, and they also have a lot of capital and a lot of businesses within those states as well. Not only just small businesses, but a lot of Fortune 500 businesses also operate. And we're starting to actually hear a couple of these S&P 500 companies that are actually reclosing their own retail stores and restaurants because of these spikes in cases. That could be a hindrance when it comes to job creation. Now, obviously, we don't want to see any spikes in any state, but those three states alone, California, Texas, and New York, are going to be very critical for the United States getting back on track uh, in the real economy, I would say. I think the equity market's already pricing that in, but we'll see if it actually comes through fruition.
Now, Goldman Sachs, they were expecting the economy to grow at an annualized rate from July, August, and ending in September. They're expecting this, 3-month quarter period to grow at 33% initially, but they pulled back on that just because of some of the issues that they're seeing in states like Texas and Florida, and a reemergence in parts of California. And so they're thinking that this quarter the economy will be growing at about 25%. So they pulled back on that. Also, they did some research, and they're now going to start incorporating how an economy how an economy incorporates the use of masks. So they're putting in their investing matrix masks, and they noticed that countries in Europe and Asia that have widespread mask usage, that they do have fewer COVID-19 cases, they have fewer hospitalizations, and fewer fatalities. And Goldman Sachs does estimate that a national, face covering initiative in the US could prevent a 5% hit to our national GDP. And so the thing is, they also researched people on, do you wear a mask? And the numbers of people wearing a mask throughout the country is on the rise. People answered that they always, or at least frequently, wear masks. So, I personally find that, encouraging. But of course, there's been big debate on, public, on personal freedoms and using masks. But this week, we do have continuing claims on Thursday. So we're looking at the economic calendar. And Kevin, is there anything on the calendar that you're looking for this week? Or also the ISM number came out earlier today. Do you have, any comments on anything on the calendar here?
Yeah, I thought it was interesting. We saw the ISM non-manufacturing numbers came out today. I think it was 57.1 versus the market estimate of 51. So we did see a bigger than expected expansion within the basically the services sector, which is also a reason for a little bit of the boost in the marketplace. But really, what I'm going to be looking for is going to be the core PPI and the PPI numbers that are going to be coming out on Friday. So obviously, we do have continuing claims and initial claims. We're going to watch that every Thursday. But I'm actually really curious to see the PPI numbers. And really, it's just going to be the change in the price of finished goods and services. So the core PPI is going to exclude food and energy, and then the PPI numbers are going to include food and energy prices. And it's kind of a barometer of inflation within the overall marketplace and for the consumer itself. So I'm actually curious to see how those numbers turn out. Do we see any type of rise, or if we continue to see a little bit of a flat, basically a flat level of inflation across the board? And if that is the case, then I think the Federal Reserve is probably going to continue on their path. If you see any type of indication of increased inflation, you might see an adjustment from Fed policy. So just really the indicator that I'm looking at for this week. How about yourself?
Yeah, no, definitely I'm going to be looking at the core PPI. And last time around, there in the PPI, there was a lot of talk about, how US producer prices increased a lot more than expected. And they also were focusing on just the cost of meat. And it's true, when you go to the grocery store, you see it really across the board, especially beef prices are rather high. And and the Federal Reserve does track the PCE, the uh, core core personal consumption expenditures, and they're trying to keep that at its 2% inflation target. But in May, wholesale food prices did increase 6%, and there was a 1.6% in jump in goods prices. So it should be, interesting to see what happens to the core PPI. All right, and I'm also going to be paying attention to just the continuing claims number. Now, Bank of America actually expects the jobless claims to be relatively unchanged from last week's uh, uh, 1 point, for about 1.4 million. And they were saying that this year's going to be a bit different because of the automaker shutdowns. Usually there are more unemployed because they shut down and they sometimes they retool these factories and adjust their employees based on what new model they're going to be making. So that's not going to apply this year, which is rather unusual. So they don't think it's going to change all that much. Now, you traveled, I know, Kevin, you said that you spent some time in Chicago just now. You were working from, your family's home in Chicago, and you just drove back to Denver. And did you see a lot of people on the roads?
We did see actually a fair amount of people that were on the roads. Now, we actually drove back out to Colorado on Friday, on the day
Mhm.
before July 4th. So obviously that's going to be a heightened day when it comes to traffic. But we did see a fair amount of people on the roads, and I think a lot of people are trying to actually just drive now compared to taking a plane just because of the risk for COVID-19. But Nina, I think the really interesting part about the whole trip, actually, there's two items. One interesting part is the very big discrepancies with gas prices just between Colorado, Nebraska, Iowa, and Chicago, or basically in Illinois. You're actually seeing a very big divergence where I would typically see maybe a 15 to 20 cent, maybe 25 cent rate of
Mhm.
change. And there were some areas where I actually saw up to 60 to 75 cents as an adjustment. Now, if we actually put that in nominal dollars, you're looking at a 35 to 40% increase, depending on where you're at. So it's just that was actually very interesting. And then some states they are very relaxed with their mask policy, and other states like Illinois, they're very strict. So it's interesting to see the different dynamics between the states. And obviously, everybody wants to be opened up. I think it's just making sure that we're all on the same page as far as how we do that, and making sure that we stick to it and try to overcome this thing. And I know it's turned political, but unfortunately, I think
Mhm.
everybody needs to try to practice the mask policy. If we want the economy to open up and we want the equity markets to continue to do well, we want consumers to start spending, we got to make sure we get COVID-19 contained. I think that's a message that we can all agree to.
And yeah, and if the price of gasoline does drop, if it's rather low, I know a good portion of the differences that you do see across the country can be the taxes. You know, some areas definitely have more of a gas tax, especially certain counties over others. But I did read that AAA is forecasting that US summer travel will fall by 15% compared to last year. But originally, travel through July through September has been increasing at an annual rate of more than 3% over the past 4 years. So, it's been growing, and then all of a sudden, boom, 2020 hits. And also people are not Googling, airlines, where do I get the best flights, the best prices. They're not Googling, airlines or travel websites like Expedia or Travelocity like they were before. And right now, people are Googling for, and we've talked about this before, about RVs and boats. And you like to fish, so are you thinking about getting a boat?
I have a
You have
boat
one?
right now. I have a boat
Great.
right now. I'm going to stick to it. I don't want to take on any additional payments, but
Hmm.
when we go to the state parks here out in Colorado, I think that's one of the bigger hobbies that people have really taken up is trying to go boating more, trying to be in the outdoors more. And rightfully so. It's pretty much the only thing that we could do for the first month and a half. But it is starting to provide a little bit of congestion in those state parks, and we are seeing a little bit of an increase in the outdoor, activities, hiking, camping, boating. So uh, I'm not surprised with the trend in that going up.
Now here's crude oil, and last week crude oil ended up. Let me zoom in a bit. Once again, I had to just review what was going on. It ended up 5%, which that's pretty big move up. Now other commodities, um, for the week, gold wasn't up that much, but it did breach on Tuesday, 1800. We'll take a look at that too. But here's crude oil, and I know you like to trade crude oil futures. What type of range do you see crude oil staying in? Do you think it maybe has potential for any breakouts?
That's a good question. So if I'm looking at a range, and I'll actually just use through the end of this year, so for the next 6 months, I've been actually still thinking that there's going to be a range between the $32 a barrel on the support side on the bottom end, and then $45 a barrel on the top side. Right now, we're seeing a nice little range between $35 and $40 at this point in time, and it's been a particular range. But we do have some items that are going to be coming up later in the year that's going to impact crude oil. So not only are we trying to reopen, as I stated earlier, we're looking at those states, California, Texas, and New York. Well, New York is a very big consumer of not only just oil products when it comes to gasoline and byproducts of oil, but also consumers when it comes to plastics, which the majority of oil is actually being used to
Hmm.
manufacture plastics. So if we're not able to actually reopen and get those consumers starting to spend and consume in the northeast region of the United States, you can see a little bit of a demand drop for oil. But we also have the elections coming up. So I would say probably September, October, and November, we're going to see heightened volatility, not only within the equity market potentially, but you probably will see that in the commodity market as well as the rhetoric starts to creep up when it comes to not only domestic policy, but also geopolitical or foreign policy as well. So, how are you going to be dealing with Venezuela, Iran, North Korea? How are you going to handle those countries, and what's going to be the difference between Trump and the presumptive nominee Joe Biden when it comes to managing those? I think you'll start seeing a little bit of a little bit more volatility within the oil market. Now, will it go back to volatility that we saw a month and a half ago, where we're seeing negative prices? I doubt it. It may happen, right? we probably will start seeing a little bit more of a range within that, like I said, $32 to $45 range. And I would say probably the equilibrium is going to be around $41 as being our average for the remainder of the year.
Now, the Dallas Fed, they conduct surveys all the time, and they like to focus on energy. And they completed a survey on June 18th, and it was released at the end of the month. And one of the questions that they asked these energy execs is, where do they think that West Texas Intermediate, which is the crude oil that we're looking at right now, where they think that crude will be by the end of the year. And overall, 62%, they answered that crude oil will be 44.99 or lower, and 38% said 45 or higher. But basically, the range is, 35 to $50. But the average price was the overall price. Trying to see, did they come up with that number? No. I guess the biggest winner was probably around the $45 level. That's where they see crude oil at the end of the year. So I thought that was rather interesting. So if you do trade oil stocks or you trade crude oil futures, it's a good idea to go to the Dallas Fed website and check to see their latest surveys. They have a lot of interesting data there. All right. Now, do you have any other futures you want to look at? You want to take a look at, how about we take a look at gold? And gold, now the front month for gold would be, is that September, or should I be looking at August? Which one should I look at?
Let's look at the September. I'll pull up
September?
my chain just to
Okay,
make sure.
let's take a look at that. Whoops. Let's look at a 1 year. Let me look at what did I do to my little candle? Well, those are just, all right, it's just listed. Did I do something odd? Here we go. GC is gold, right? And then I'm doing, let me put Q up there.
Actually, we can look at the August. The August
Yeah.
the Qs is going to be the active month for right now.
And we can see that there was, if you've ever listened to, it's almost an equal and opposite candle here. There's some type of rejection going on at those previous levels of 1800. If you ever listen to Dan Gramza, he likes to look for candles that are, it's not quite, so he probably would say it's not quite an equal and opposite candle, but he likes to look for those, that it is a rejection of that, 1800 level. Which ended on the green, closed above that 1800 level. The next day we opened there, traveled beyond it. A particular futures product. But, Kevin, what do you see here?
Yeah, I mean, for gold, obviously, it's a little bit of a flight to safety for most investors and most institutions there for right now. Right, we're hitting the fresh highs, 1795. Right now, it looks like it's still hitting that a little bit of a resistance point right at the 1800 level. So it's going to be interesting to see if we can push through that. But what I've really been looking at, Nina, is the difference between gold and then also doing an overlay with the TNX. So looking at the 10-year, and the reason why is it's been very, very interesting to see where is money really flowing once we see some of these sell-offs in the marketplace, and is it actually going into gold or is it going in back into treasuries, and why? And trying to just make a correlation to see if there is a if investors are actually looking more towards gold rather than looking towards the treasuries in itself. And personally, from really what I'm looking at, it looks like gold has been a little bit more of the safe haven, not only just for market volatility, but also some inherent inflation fears that are out there in the overall marketplace, as we can kind of see gold rising compared to the actual interest rates. Now, the interest rates falling, meaning the prices for the interest rate products themselves are rising. But I just thought it was a little bit interesting to see a
That is
little bit how
interesting.
dynamic and stable gold has been over the past year compared to how unstable the treasuries have been, and then just looking at March through July and just seeing the correlation between those charts, you could continue to see that gold has really been still moving up on the uptrend relative to the treasury. I think investors are really trying to utilize gold as that safe haven, maybe rather than the treasury products because of the overall yields you could receive. So just something to keep in mind there. And I think it'll still be that barometer. So there might also be a correlation with gold and the VIX. I haven't really been looking at that, but it's just where is that flight to state safety going into? And I think that you know Mikey was talking about it earlier on the futures webcast that I was watching, and really it could be that gold and treasuries have really kind of fell out of favor with investors. It could actually be technology. It could be the technology sector itself that is looked at as the safe haven. A
Hmm.
higher beta, definitely, but it has been able to achieve results. I'm not sure if that's complacency in the marketplace, and I'll ask you that. Maybe that is complacency. Maybe they're
Well,
going to
people,
take risk in the equity market compared to some of the other staple type of safe havens that we're used to in the past, like gold or treasuries in itself.
well, in the situation that we're in right now with this global pandemic, people are turning to technology to be the answer to a lot of the problems. All right, you can't go to work. Okay, is it possible to work from home? Okay, technology's got a solution. All right, you can't go to school. Well, let's do schooling at home, even though it's pretty tough, but let's try it. Technology's got a solution. In healthcare, we need this healthcare crisis, of course, solved, but what are some of the things that can help solve the issues or alleviate parts of the problem? Well, it's of course, a lot of it is technology, to test for people, and that incorporates other sectors too, like biotechnology, but a lot of it needs some type of you know, thermometer scan or different things like that. So, technology or just tracking people how they're walking around. They're turning to Google and Apple, and so that all of these firms can potentially, I guess, spy on us, but it's for the sake of keeping track for where everyone is. So yeah, I do agree with you, and I agree with Mike that you know we're really putting a lot of we're putting a lot of hopes on technology too. So
Now, Nina, we actually have Joel in Texas. I wanted to present this to you. So, because I know we'll talk about earnings here
mhm.
shortly. So Joel is saying during last quarter, stocks rallied about a week before their earnings, specifically cloud stocks. Do you see this strategy working again potentially? And do you see the implied volatility on the earnings next week for Q3 stocks to be a high one relative to in the past? Or do you think the market's really just brushing off that market? So obviously it's like three questions in one, but first and foremost, do you kind of think that the marketplace has already priced in uh, earnings for these technology stocks, specifically the cloud stocks? If you're looking at Zoom, Apple, Amazon, um, things of that nature, do you think that market's already priced that in, or is there some room to go when it comes to earnings?
Well, that's the thing, definitely right now they're pricing in for, potentially some action. And what you can do is right here, I'm on the screener, we're on Street Smart Edge. You can check out performance by sectors. I like to look at, let's say, the, year to date performance, and you could see it right here. Overall technology is up. If I just collapse this, you could see, it's the winner up here. Second place is consumer discretionary. Then you could open this up. Now, these are all the stocks in the universe here of American listed stocks. So it's not just the S&P 500 here, but you can break it down and see which ones have performed the best year to date. And here's software. Software is up 34%. Application software, system software. You can see it's application software. So that goes back to what I was, talking about earlier. But communications equipment, this is actually quite interesting. Communications equipment isn't faring so well, and neither is electronic equipment. So it truly is the software, and especially as Joel pointed out, the cloud stocks. So what you can do is look up, individual stocks. Now there are some, ETFs that are cloud-based. You know what, and they have symbols in them, cloud, like it's CL. I'm trying to think of the actual symbol. Then you could break down to see what stocks. I know that there are, many, many different ETFs out there. And I also like the fact that you just brought up volatility too. So we'll take a look at the VIX. But let me see. I know Lee knows. Cloud. Here, this might be. I don't know what the IV stands for. But you could look up different. Let me remove the overlay here. Get rid of the TM. You can look up. I'm not quite sure what this one is. So once again, you have to research this. Don't run out and trade this. And then you could click on, well, what's this one? Because there's lots of commercials on, on TV where they talk about the symbols. And then here you can see what stocks they have. Here's Twilio, there's Zoom Communications, which many of you might have heard of. There's, let's see, Workday. Many people use this at work. And you could check out the individual stocks. And I don't think that there are options available to trade on this. I don't think so, but we could just take a look. Are there options? Yes, there are options. So we could take a look at what the implied volatility is. Let me put the IV on there. Oops, they just listed. They just listed options. So that's the issue. We can't really do any options analysis about the volatility because there's not a history of this. So this could be, tough to trade, but you could see that earlier, in the month, you could see that the volatility was rather high. I'm expecting that volatility before earnings on any of these stocks would probably pick up, but I don't, um, I don't know exactly where a stock's going to move because there's high implied volatility. High implied volatility is inferring that there's greater potential for stock for potential for stock movement. So Joel, do you have a cloud computing ETF that you look at? I'm trying to remember. I know there's one from Fidelity, and you could look to see what the volatility is doing. So Kevin, what do you think? You think that volatility will be pretty strong? Stay where it is as we head through
For,
earnings?
for the overall marketplace, I would say that our volatility is probably going to stay probably roughly where it's at as of right now. I mean, we're at pretty much 28 for implied volatility right now. And if we're looking at it, it's roughly a little bit lower than a 2% move. It's pricing in about a 1.76% move. On a daily move right now, probably will see volatility spike up a little bit as it comes up to earnings. But Nina, this is going to be an interesting earnings season because a lot of companies that are going to be reporting, and a lot of the uh, NASDAQ 100s and a lot of the big market cap companies in the S&P 500, they're going to be reporting, and some of them actually do not have guidance. So how
Right.
is the market actually going to react to that? It might actually react a little bit favorably because you're not really putting you're not putting a bar up. So, or the market could sell off on it. Who knows? But overall, that might actually cause the implied volatility to maybe not rise as high as we were traditionally looking at when it comes to earnings, because some of these expectations, they don't have any guidance. So it's going to be interesting to see how the market reacts to them. But I mean, if we are any judge of market data at this point in time, when we're looking at employment data, when we are looking at the ISM manufacturing and non-manufacturing data, even when it was not looking too well, and how the market reacted. I mean, it's been reacted pretty favorably to numbers that that didn't even meet expectations, or maybe just met expectations. So we'll see how the overall market reacts. But just from my point of view, the estimates compared to the actual numbers, it seems like the market um, hasn't really cared for it one way or the other at this point.
And then you have to break it down also by, sector, because if you take a look at, FactSet is saying that earnings overall, year over year for this particular quarter that we're finishing up, that earnings are going to drop 43.1%. But, that's not for every particular sector. They and if you go to FactSet, they have those numbers as well. And my computer, I had those numbers up here, but my computer had like a power surge, and that just left. But I'm going to look up what they have for different quarters. And FactSet is just a great resource, because when you average it, it's all the sectors, all 11. And let's see, 11 sectors. This one, they're expecting energy is going to be down 104%, consumer discretionary down 60.8%, but that is for the first 6 months of the year. So they kind of switched it up on me. And so that's the issue. That's not just for the quarter. That's for that's the year. So that's the latest data. So it's not exactly what I was looking for. But we had Joel said that he's been looking at, once again, this is not a recommendation, just run out and research what these ETFs are and what the underlying, what types of holdings do they have. For this IGV, you could see that the top 10 holdings, some of them are the same. And some of them are very familiar names. There's Microsoft, Adobe, Salesforce, Intuit. And then we could see the implied volatility spike that we had. Now, we had it before, last earnings season, but keep in mind, what time frame are you exactly looking for? Because all of the stocks, in the middle of March had that volatility spike. So if we're going into July, so keep that in mind. And then if you're talking about earnings for a particular company, at the end of, so 3 months ago would be April. You could see the volatility a bit than it is now. We'll probably see it get to similar levels. I'm not quite sure. I think April was definitely a more volatile time. I'm thinking we definitely will revisit, the volatility that we had here. Let me hover over this candle. Yeah, around June 11th. We'll probably get near those levels, just because that's pricing in for a range of movement. I wanted to share with you the calendar. Here's the calendar for earnings. Let me move this a little over. Here we go. So here's earnings. Now this week, so today we didn't have any announcements. This week is really, really light. I just wanted to point out that if you go to the Research tab, hover over that, click on Calendars. Once you click on Calendars, go to Earnings, then you can click on a particular date. I just wanted to show you that Walgreens is coming out with earnings on Thursday, and maybe my internet is a little slow right now, but it's coming out on Thursday. So let's take a look at the chart on Walgreens, and let's talk about what happens to volatility as we get closer to earnings. So what I have overlaid, I can overlay it on the top, I should say, but I have the implied volatility on the bottom. And Kevin, can you talk about what typically happens to earnings as we head in, what happens to volatility as we head into earnings?
Sure. So typically when you see a event like earnings, that's pretty much planned. As we lead up to earnings, you're actually going to see the implied volatility increase because the overall market itself is placing a bet on the stock either moving up or down. So as the implied volatility moves up higher and higher, the option prices themselves are also being inflated. So you typically will see the implied volatility move up, and then once you actually have the event like earnings, you'll see an immediate drop in implied volatility because the event is over. Now the market is able to digest the information and be able to have price discovery. So if we actually look at the past three earnings that you have on this chart now, the one that we have in early March or late March is going to be a little bit of an outlier just because of the overall volatility we had in the marketplace in itself. But you still see a little bit of a spike, but relative to the other implied volatility that you see in March, it was actually a little bit less on average. But you'll see it's just an immediate drop in implied volatility. And Joel was really talking about that in the question there. Typically, you'll see a little bit of a spike. Now, how much of a spike? That's for the market to be able to price in. But after the event, you'll typically see the implied volatility drop until the next earnings cycle.
I mean, yeah, I'm guessing it probably will get for individual stocks as you head into earnings for those, let's say, cloud stocks. I'm guessing it would get higher than where we are right now because there can be that 1 day move, as you pointed out. And so when volatility drops, the extrinsic values, they leach out of the options rather quickly. Okay, all in one swell, one fall swoop there. Now, last time around for Walgreens, they actually beat expectations. They had more foot traffic at the first 21 days of March, but then people, stopped going to Walgreens after they stocked up on their drugs. So they then saw it drop later on, especially if a drugstore is near a restaurant that's closed or near a casino, let's say, that's closed. Walgreens experienced, less traffic in some of their stores. All right, now their net income fell, but they did beat what was expected. They did beat what was expected. In this case. Now, what was the average move? If you go back over the past couple of years, the past 2 years, the average move has been 5.8%. Okay, that's the average. It doesn't mean that the stock's going to move 5.8% the next time around, but a professional options market maker will take that into account. This time it moved 3%, another time, whoa, it moved 7%. And then they just get an average just to get a concept of, what they might be working with. However, there is some recency issues. If it recently had a big move and they think it could happen again, then maybe it'll be a little bit above the average move. So that implied volatility could stay higher. Or maybe they feel, you know what, that was just a one-time bad thing. It's not going to move as much. So maybe they're going to be a bit below that, average move that it had. So they look at the past, but of course, the past does not, forecast the future. So what we're going to do, though, is look at the money straddle for Walmart to see what the options marketplace is pricing in right now. So we're looking at the strike price that's trading closest to where the stock is trading, which is trading exactly 43. And we actually have a 43 strike price. And in this case, we can see that the midpoint, that's the average, of the price of the call and the put at the same strike, that the midpoint is $2 and let's just say $2.50. So you take that price, $2.50, and you divide by $43, and that's telling us that the options marketplace is pricing in for a 5.8% move, which is usually it doesn't work out this way, which is exactly what it's been moving on average. That's an absolute of the move up or down over the past 2 years. So that's kind of wild that that's what they're pricing in right now for a range of movement from now until Friday. Now, most of this, though, straddle price is pricing in for the earnings, but we still will have or Thursday before the market opens. The stock will react. So even if, you know, even if, you know, even if we didn't have earnings this week, you still have, of course, it's moving 2.5% today. So you have to have time value in the options just for regular trading days, right? And so that's what the marketplace is pricing in right now. And you have to take into account implied volatility is probably going to drop. It's probably going to drop after the announcement. So if you're coming up with an earnings play, you need the stock price to cooperate with you. And then you need your strike prices that you selected to either have more and more value if you bought the option or you bought the spread, or if you sold the spread or you sold the option, you wanted to have less and less value. So the relationship of the strike to where the stock is trading is very, very important. And Kevin, what are some of the more common questions you get regarding an option strategy around earnings? What are some of the things your team tackles?
Definitely. So it's going to be overall just strategy in itself. So a lot of the new options traders, and even experienced options traders, try to figure out or want to have a strategy that they could use to obviously capitalize on the movement on the stock, but also have it in a cost-effective manner. So if we are just looking at an at-the-money call option, and you're kind of referring to this, but if somebody just said, hey, I want to just buy an at-the-money call option, you could do that, but just also know that you are buying a lot of um, implied volatility. So as we just discussed, the implied volatility really gets sucked out of the options once the earnings occur. So you're not only trying to buy the right strike price, you want to have the stock move above that strike price post earnings, and you want that to be even more than the premium that you paid. Sometimes just doing a long call strategy, which could be beneficial, it does come at a cost and be a little bit more expensive. You could also try to manage a earnings position by maybe doing a call spread. If you're still bullish on the stock, you could buy the lower strike price call. For this example, we could just use the at the money $43 call, and let's just say that we wanted to sell the 47. Now you're able to.
Let's select a different one. Let's do, I'm not getting enough for that one. Maybe let's go, yeah, that's fine. All right, let's say we did this one, this 3-point spread for $1.
Yeah, so now you're basically capping out the profitability that you could potentially have. Stock goes above $46, you max out your profit, but you're able to reduce that overall cost. Now you're able to take an option and at the money $43 call that was originally going for $1.32. You're now able to reduce that cost by 32 cents by selling the $46 call. So that's a little bit more of a cost-effective strategy. And then also, you're also being able to sell the call option at $46 call. You're also selling some IV against your long position. So different strategy, obviously different price points when it comes to profitability and then overall profit loss. But in this strategy, it just reduces a little bit of the cost that it takes to get into the trade. And really, that's really what you want to try to do. You want to be able to minimize costs and then also have a profitable trade. So you could use this strategy rather than maybe doing a long call position. You could also look at, if you're still bullish, you could look at selling a put spread. And we won't go into the specifics, but you're trying to accomplish the same thing, but you still want the stock to go up, but instead of actually having a debit on the call side, you're actually trying to sell premium against it, hoping that the stock either stays the same or moves up in value, and hopefully that implied volatility gets sucked out of those options and expires worthless. So we just talked about three strategies that could be utilized in an earnings play. They all try to accomplish the same thing. They want to see the stock move up in price, but they all do it in a different way. One is just buying a straight up call. You're going to pay a lot in premium for that compared to doing a vertical call spread, which you're going to probably pay less in premium, but you cap out your profitability. Or you could do a put spread, selling a put spread where you are going to be receiving the credit. You still have a pseudo maxed loss for that strategy, but you're really banking on the implied volatility actually being sucked out of the overall marketplace in itself. Different risk with each one, but that's really the overall number one question that we have is how can I make a trade on this earnings play?
Now, Kevin, let's say the stock is higher, trading about $45 on Thursday after the announcement. And after the announcement. That's what I typically do. Now, some traders, they might, continue to hold on to it because maybe they're looking for a higher profit level. But I'm always worried that it's going to work against me, that the stock's going to retrace, there'll be some big market news, and then I'm going to lose the potential profit I have. So for me, my goal isn't the max profit potential. But different traders have different things. Let's say you held on to it over Friday. And it's Friday midday. You've got, let's say, 2 hours, 2.5 hours before the market closes, and the stock is trading about 45. So it's not above your short strike, it's in the middle. What does your team typically tell customers, to consider?
Yeah, so Nina, you're talking about what we call mid-strike risk. So the stock is ending up pretty much in the middle of your strike prices. We like to see clients try to reduce risk, overall risk, if they possibly can. So having mid-strike risk means that you could, if you let the options go through expiration, your long call is going to be in the money. You can actually have it exercised, auto exercise if it's a penny or more in the money. Now, if you have the funds in the account to be able to hold the position and that's what you'd like to do, then by all means you could do it. But
But then
typically,
you have stock risk, right? You then
right,
own the
exactly.
stock. And then if the stock opens down on Monday, well, you can have a bigger loss than the debit that you paid because you own the stock.
Exactly. And actually, a lot of people that utilize a vertical call strategy or pretty much any spread strategy, they're actually trying to get out before the expiration because they are not trying to take on assignment and or exercise as well. The reason why they're trading these strategies is because it reduces the overall cost to be able to profit off of the stock moving. So we would like to just tell people mitigate the risk as much as you possibly can. Just know that if you do take on that assignment, you do have weekend risk, overnight risk, and
Hmm.
we've seen just some devastating trades that have gone the wrong way for clients that have not taken appropriate action. So I agree with you. For me, if I'm in a profitable position, or if I'm not in a profitable position, even after the earnings, we all have winners and we all have losers as well.
Mm,
Sometimes it's just better just to take risk off of the table,
right.
reset yourself, and just prepare yourself for the next trade. And that's what we try to advise our clients to do.
And don't feel that you're alone out there. If you have a question, don't wait for the last 15 minutes of the day. Also, you'll notice that as you get closer to the end of the day, the markets get wider, especially on, let's say, an expiration Friday. You're going to have the markets a lot wider. So I typically will try to have, if I have a trade, into expiration, I try to have that thing shut down, 90 minutes before the market closes on that day. That way, you get nervous when there's a few minutes to go, you know? So, shut it down earlier and then you could be done with the strategy. Okay. Don't try to milk. And if you have a winner, don't try to milk it could turn into a loser. It's possible. So keep that in mind. But don't feel that you're alone out there. If you're on Street Smart Edge, if you have any questions, you can go to Live Help, which is right here, or you can also, call up Schwab. Talk to one of our option specialists, talk to one of our brokers on the phone, and you could be talking to someone on Kevin Green's derivatives team, and they could help you go through your different choices that you have and talk to you about, how to use some different tools and features that are available to you as well. So Kevin, do you have any closing remarks before we sign off?
No, I always appreciate being on the segment with you, Nina, and I hope that everybody's trades go in their way this week. And it should be an interesting week when it comes to economic data. So hopefully everybody has a good one.
Great. Thanks again, Kevin, for filling in for me last week. And I enjoy hearing you when you are hosting with our special guests on closing remarks. So that's always a special treat. So once again, thank you. And thanks